What if you could combine three powerful trading concepts into one strategy capable of producing sniper entries and massive risk-to-reward ratios? That's exactly what you're about to discover in this video. Before we dive in, let me show you what you will learn in this video. Liquidity sweep concepts and how they may reveal institutional footprints, how to identify high-quality supply and demand zones, how to use candlestick patterns to confirm reversals, how to combine these concepts into one powerful trading strategy, how to find sniper entries with exceptional risk-to-reward ratios, how to apply this strategy in both day trading and swing trading. This strategy can be applied to forex, stocks, indices, commodities, and cryptocurrencies. Before we get started, if you enjoy our videos, make sure to like this video, subscribe to the channel, and hit the notification bell so you never miss a new upload. Now, let's dive in. The first concept behind this strategy is the liquidity sweep. There are three important types of liquidity sweeps that occur in the market and that you should understand. The first type is a liquidity sweep with a tail. This occurs at a support or resistance level and is characterized by a long wick. In the case of a liquidity sweep at resistance, the market forms a long upper wick. In the case of a liquidity sweep at support, the market forms a long lower wick. The second type is a liquidity sweep with one candle. The market reaches a key level, retraces back to it, breaks it with a single candlestick, and then another candle closes back below the level, as shown in this example. As a result, stop losses are triggered, and many retail traders become trapped. The third type is a liquidity sweep with multiple candles. In this case, the market reaches a level and reverses, forming, for example, a support level. Price then retraces back, breaks below the level with multiple candles, and eventually closes back above it. This is what we call a liquidity sweep with multiple candles. Now, let me show you an example of a liquidity sweep with a single candlestick. Take a look at this chart example. As you can see, the market hit this level and reversed, forming a support level. Now look at what happened next. The market broke below the support level, and breakout sellers thought it was time to sell the market. But look at what happened next. Another candlestick pattern formed and closed back above the support level. What happened here was a false breakout, designed to shake out sellers and trigger their stop-loss orders. Now look at what happened next. The market moved strongly to the upside. This strategy is often used by institutional traders, and in this video, we are going to combine it with other institutional concepts to identify some of the best trading setups in the market. Now, let me show you an example of a liquidity sweep formed by multiple candlesticks. Look at another chart example. The market moved up, hit this level, and reversed, forming a resistance level. Now look at what happened next. The market moved higher and broke above the resistance level. At this point, breakout buyers thought it was time to buy the market. However, look at what happened next. The market formed two candlesticks that closed back below the resistance level. This is another liquidity sweep that occurred to trap retail traders and trigger their stop losses. Now look at what happened next. As you can see, the market moved strongly to the downside. Now, take a look at another chart example of a liquidity sweep with a candlestick tail. As you can see, the market was trending upward. It reached this level and reversed, forming a resistance level. Now look at what happened next. The market returned to the resistance level, broke above it, and then closed back below it, forming a candlestick with a long upper wick. This wick represents the liquidity sweep. A liquidity sweep with a long tail is considered one of the strongest types of liquidity sweeps because the stop-loss hunt happens very quickly before the market reverses in the opposite direction. Now look at what happened next. As you can see, the market moved lower exactly as expected. If you open your charts and start looking for these setups, you will find many of them because this is one of the ways institutional traders trap retail traders before moving the market in the intended direction. Now, let's move on to another institutional strategy that we can use to track institutional footprints. Take a look at this example. Sometimes you will notice a very strong move to the upside that clearly stands out on the chart. Such an aggressive move often indicates institutional activity because retail traders alone cannot move the market this way. Once we identify this move, we draw a zone at the origin of the impulsive move. This area is called a demand zone. The reason behind this is that hedge funds and large institutions cannot execute all of their buy orders at once. Instead, they gradually accumulate their positions. As a result, when the market retraces back into this area, institutions often step in again and continue buying. This is why you frequently see the market retrace back into the zone and then rally strongly once again. This area is called a demand zone. If you can identify these zones and combine them with liquidity sweeps, you will be able to track institutional footprints and gain a better understanding of where institutions may enter the market. This allows you to trade alongside them instead of becoming victims of their tactics. The same principle applies to a supply zone. Sometimes, the market makes a very strong move to the downside that clearly stands out on the chart. This aggressive bearish move can also indicate institutional activity. We then draw a zone at the origin of the move, which is called a supply zone. When the market eventually retraces back into this area, institutional sellers may step in again, causing the market to move strongly lower once more. To be able to identify supply and demand zones, you first need to understand the four main supply and demand patterns. The first pattern is called the drop-based rally demand zone. In this pattern, the market moves down, pauses for a short period, and then rallies strongly to the upside. The second pattern is the rally-based rally demand zone. Here, the market moves up, pauses, and then continues moving strongly higher. The third pattern is the rally-based drop supply zone. In this case, the market moves up, pauses, and then reverses sharply to the downside. The last pattern is the drop-based drop supply zone. Here, the market moves down, pauses, and then continues moving strongly lower. These are the four most important supply and demand patterns that every trader should understand. Now take a look at this chart example. As you can see, the market formed a rally-based drop pattern. This is what we call a supply zone. Notice how the move to the downside is quick and strong. The candlesticks are large, and the previous support level has been broken. This is often considered a footprint of institutional selling. Now, we draw the supply zone and wait to see what happens next. As you can see, the market later moved higher and eventually returned to the supply zone. Once price entered the zone, a clear bearish engulfing pattern appeared. This pattern indicates that sellers have overwhelmed buyers and that the market is likely to move lower. Now look at what happened next. As you can see, the market moved down exactly as expected. The rally-based drop pattern is an institutional footprint that occurs frequently in the market, and when identified correctly, it can significantly improve your trading results. Now, take a look at another chart example. Here, we have a drop-based rally pattern, which forms a clear demand zone. As you can see, the market makes a strong move to the upside. The candlesticks are large, the move is quick and impulsive, and the previous resistance level is broken. After identifying the demand zone, we simply draw the zone and wait to see what happens next. Now look at what happened. As you can see, the market retraced back into the demand zone. Once price reached the zone, it was strongly rejected and moved higher once again. Supply and demand zones are considered the footprints of smart money, and when